The slides okay? Great, because I can't see really anything else. Okay, so your host, we just went through that a little bit. Logistics, this is a meeting, so, kindly stay muted. That does mean that we will, if you have questions to ask, we'll have some opportunities for that. Put them in the chat, and yes, we will share the recording and the slides. We actually usually send them out in our Take Group member updates, but we also send it to all the people who registered for the webinar. All right. So today, what are we going to do? We're going to present the data, and it's a lot of data. And I'm going to tell you, I'm going to go through some of it pretty quick because it is similar to what we've done in the past for many years. So if those of you who have been on this webinar or seen the HMDA presentation, it will be fairly familiar. But we do see things that are change every year too, so it's worthwhile to talk about it. But we have two of our lenders today's webinar to really talk about some of the work that they are doing in this space, and particularly how they're thinking about racial disparities in home ownership and access to credit. So that is where we really want to kind of focus some of our efforts. So that's under our share best practices and strategize. But with the data, just know that we can always do a follow-up session if you're interested in getting really in depth in something. Also, this is information that our work groups can then take and use. We've got these great charts that show your top lenders, and this is all information that our membership can use as they do work together around this issue. Let me just make sure. Is there, Bethany Lamont, is there anything that you want to add to that before I forget?
No, I think that was a good introduction.
Okay.
Thank you.
About Take Root, this is a lot of information, but we are now a consortium of 57 members, which is amazing. And so we have organizations that are community-based. We have housing counseling organizations, local government, realtors, lenders, and other partners like WIDA that do this work with us. And we do this in two ways. We have a public out-facing presence where we really promote trusted resources to the public. It's a one-stop shop, and it's a way to promote the resources that are already present in our community. And then we have a practitioner side of things, and that's webinars like today, but we have working groups and a network. It's a great place for, as you have new people come onto your team, to get engaged in this work and make those important connections. So you see all of the different ways we support both members and residents in the community. A little more about Home Mortgage Disclosure Act data, or HMDA. I really try not to default to acronyms, but even just saying Home Mortgage Disclosure Act is always difficult. But here's a little bit of information about the Act and why we get this data and where we get it from. And so Bethany, I don't know if you want to go into a little bit of detail about this.
Sure. Well, you can see the bullet points, but I'll just say that really the HMDA data is what enables us to have more than a sense, to have some actual data about what lenders are doing in our marketplace. Any lender that does more than 100 loans during the course of 2 years is required to provide a wide range of information about the loans that they are making, about the demographics of the people that they're lending to in terms of income buckets, and the racial demographics, gender, age, and then a wide variety of information about the loans themselves. And it's all aggregated and can be pulled out by city, by the county, the MSA, or the entire state, or the entire country for that matter. And we can do it lender by lender, or all lenders as a group, or cut the information a lot of different ways. And it's super helpful to look at what's going on in our neighborhoods. And like Christy said, compare the data from year to year.
Yeah, and I'll just add too, I've realized over the years of doing this that it actually really helps us open up conversations with our lenders. Like, you have this data and you can really talk to them. I think it's just a really great place to start when you want to think about it from a community-based perspective, and thinking about who are your partners and what they can be doing and how they can do more, right?
Yeah, definitely a way to hold them accountable. But I really think it has a tremendous potential to foster new partnerships and also influence products that are needed, in the community. So it's been a win-win for us.
Yeah. And so what kind of data do we have? So Bethany described a little, all the many, many ways you can look at HMDA. There's like just really great reports. You can do these like overall reports that break down all those demographics, and she is always available for you to, if you're interested in having a report, reach out to her if you want to know some more, if you want to look at a specific lender. We also have pulled out some of the economic data by race and ethnicity for the city and the county. So you'll see that with some caveats. I think many of us know that the 2020 census has some problems with the data. So I'll talk about that when I get there. And then we usually look at our top 25 lenders. This is always interesting. So we look at the purpose of the loans, like what kinds of loans are being originated, who they are made to, and then where. And then we compare our group of take group lenders to all lenders in the city, which has always been fairly interesting and informative to think about. Lamont, I don't know if you want to add anything else to this, or Bethany, you too. Nope. Okay. So why do we do this? Well, we talked a little bit about that, but this is a great way to break it down. It's informative. Data is interesting. It can be comparative. So what changes are we seeing? Where are the loans being made? Which lenders are doing well, particularly with borrowers that have been traditionally underserved? And it can support and strengthen our work. And this is really the what we do with it. You can have lots of information. You can put it together like, we do here. We kind of break out these reports in different ways. You think about it, you analyze it, but the point is then what do you do with this? And so over the years, we've really used it to think about what kind of strategies could we pursue together? And then maybe what are some new lenders that we should really be reaching out to and having conversations with?
Yeah, Christy, one thing that I would like to raise up, and might have said it already, but it bears repeating. So you can break it out by all home loans. The information, you can look at all home loans as a group, which is what most of these slides are doing, but you can also look at just the home purchase loans, or just the home repair loans, home improvement loans, or just the refinance loans. And there's actually two buckets of refinance. There's the cash out refinance that you can look at separately, or just the basic refinance that's not necessarily a cash out. So if you're interested in home improvement and you want to see who's doing that kind of lending in your neighborhood, that's something to look at.
Mm-hmm. Yep. So recap our framework for the webinars. So last year, the Urban Institute released this really great blog that we'll show on the next slide. But we really started to think about this data in a different way, because as we all are very well aware of in this work, that the homeownership gap between Black, Latino, and white households is wider now than it was. Now I can't do math in my head, but 1960, 50 years ago, 70 years ago, I don't even know anymore. And then we also know that applicants of color experience higher mortgage denial rates. And so we looked at that really deeply like a little over a year ago when we looked at lending disparity profiles in detail. And this blog really talks about credit indicators in a way that we thought was really helpful. So we kind of wanted to put this back into your mindset as we kind of move along. And that the other thing to think about is that mortgage underwriting standards were developed also many, many, many years ago. And so they also reflect this legacy of systemic racism. So, I mean, it's kind of silly to think that it would be in one system, but not the other, right? So I think that was what this blog for me was like, oh yeah, like, I mean, we all know that, but it really spells it out. And so Bethany and Lamont will kind of talk a little bit now about these key points in the blog that I think will be helpful.
So I think most people are aware by now that communities of color have been denied access to services that help them to build credit, and that if you don't have a solid credit history, lenders appropriately are not going to lend to you. I mean, with the exception of the lenders that lent to anyone in the subprime predatory lenders that lent to everybody and convinced everybody in the run up to the foreclosure crisis that they could get a loan, and they'd be stupid not to get this loan. Yeah, it meant that there's this gap, and that we're dealing with this legacy still.
Yeah, I just like to add, a lot of being denied access to services has this effect that makes people just despondent. They don't want to try. And then over time, they just lose the knowledge of what it takes to get a loan. So it's important not only that we uplift that people are being denied, but we also have to uplift the educational piece. How can we give people who've been denied the information about what they can do once they've been denied, what they can do to come back to the bank a year, 2 years later, and hopefully be in a better position. And we have a great housing counseling network, but a lot of folks, they fall out because they get despondent and they just don't try. And so we have to work on that too, to, re-engage folks who do fall through those cracks.
Right. I think Lamont makes a really important point there, that if you think the system is not working for you, right? Like, why would you think that the change would be there? Or why would you even bother to think that this could be something you could do? And I think we sort of underestimate that generational and decades long sort of impact when we think about reaching out to people.
And that's why Take Root Milwaukee is so important, to help people understand what is possible, and working together with the banks and the community folks, the neighborhood organizations and the homeowner counseling agencies, to help people understand that with the rent that you're paying, if you can build up a little bit of money to add to down payment assistance, and if you've got a good credit record, you can actually own your own home. And now with the community land trust, that's going to make it even easier.
So
absolutely.
I highly encourage you to check out this blog. We will send a link to it, even though it's over a year old. I feel like I reread it every now and then because it's just super helpful for me to reframe in my mind kind of what's important. Okay. All right. So the economic disparity data. I'm just going to say, I wanted to update these charts, even though I knew the rates themselves probably didn't budge that much, and they didn't. But I will, so I reached out to my trusty data person at the City of Milwaukee, Department of City Development, Kate Madison, and she sent back some year one, I think 2020 or 21 American Community Survey data rates, and the breakdown by race was very off for a couple of groups. So I was like, I'm just going to stick with this other 5-year average we have until I can find out from her what's going on. But I will say the overall city home ownership rate was 41.3% in that data set. So like we're talking about, and we're looking at this year to year, the changes you would like to see would be over a longer period of time. But as you can see here, we have significant gaps when it comes to race in terms of who owns a home in both the city and the county. And so this has been well documented, but it's always helpful to have the numbers and think about the gaps that need to be made up. And then this chart is also older, but still very informative because you see over time that the disparities actually have been steady or have they increased. In particular in the last like 2 decades, if you will, in the Great Recession. And we all know, because Take Root formed out of that foreclosure crisis, that was something that we've always been concerned about, this loss of home ownership, and particularly both in neighborhoods and in like majority minority neighborhoods, but as well as minority populations. And so even though this is older, it's from the PolicyLink National Equity Atlas. In fact, I completely forgot to go see if they have an updated one. I should check, but the line graph, it's like the image of it is almost to me the most important because it really brings home that this is something that was decades in the making. it will probably be decades into correct, if you will.
I just wanted to add, you kind of see that there was progress being made until about 2010 for people of color. But now we're going the opposite way. Whites are becoming more and more homeowners at an increased rate, and people of color are actually sliding in this. So we have something seriously going wrong since 2010 that we need to correct.
And actually, we'll see later that it actually is starting to move in the other direction, which is great news, yeah. But there's still a lot of work to do.
Yep. And then the other data set we bring into this is median household income, which just, again, breaks it down by racial groups as well, so you can see the disparities. It's always helpful to be very clear about this. And we also show the city and the county because it is different. But again, I did not mess around with these. Those numbers weren't too off, but I didn't want to use different data until I could get some clarity on what was happening with the other data. But again, I think we all know that, obviously someone's income is a huge indicator of whether or not they'll be able to buy and or maintain a home. And so when you think about the average median income, and then also you could think about the average median price of a home in whatever geography, city, county, and what's affordable to people. And if, Black African-American people make considerably less money as a household, that means that their purchasing power, their ability to purchase a home, where they buy a home will be limited. So, income is also, it's like you can think of these two different things. Where do you want to focus your efforts? You could do both. All right, so our first HMDA data chart is the lending disparity profile. And so Bethany is going to talk about this and kind of what this tells us and how to think about this data.
Sure. So start with the column on the right. So it says total apps, and we're not talking about apps on your phone. We're talking about applications, loan applications. And in this case, this report shows all home applications, whether they're for purchase, refi, or home improvement. And then on the left side, the originations column, originations are all the loans that were in kind of common lingo made, all the loans that people received, that the homeowners received. And then denials, and then fallout. And fallout refers to the loans that fell out of the home loan application process. The applicant might have gotten frustrated with the process, or maybe they just simply decided to go with another lender, but it fell out of the process before a decision about denial or origination was made. And the purchase loans are the loans that the banks purchase, but for our purposes today, we don't need to particularly look at that. But this is information for all of 2021 for the city of Milwaukee. And we can see, the differences in terms of percentages of originations and the percentages of denials for white borrowers versus Black or Latino or Asian. Again, we've still got a lot of work to do. 10,657 originations to white people, and 2,800 to Black people, and 2,200 to Latinos. That's just, when we have a minority population in the city of Milwaukee, and that's what these loans are showing, only loans on properties in the city of Milwaukee, that's just unacceptable.
Yes, so this is a different way to think about, and it becomes important when we hear from our lender guests about when somebody walks in the door and says, I'm looking to get pre-approved, I want to buy a house. What happens from that moment to get them to the pre-approval and then to the purchase where there's a loan originated for them to help them, and so that fallout rate, it's like sort of, and this is just origination. So you could look at applications, which is one other part of the report, and compare that to. And that's something that we could do another demographic, if you will. We could do another deeper webinar about that And sorry, I was reading Amy's comment. Bethany, I don't know if you see that there.
Yeah, I have a feeling it varies from lender to lender. Some people, I don't know, maybe our lender folks can tell us, but my understanding is that some lenders don't want to assume and they don't ask. And so that's why the unknown number is pretty high. Others are, more comfortable with doing so. And yeah.
Right. I'll just say given how much we work with racially disaggregated data in our field, it makes me much more I'm going to fill out all my demographics on a survey. Right. It's it helps with the data.
Right. And I would think that the lenders would want to report the loans that they're making to people of color and to make sure that, that what's being shown about their record is accurate.
Right. And some people just choose they don't want to say because, they don't want to say. But then sometimes I'm of that mind. I'm wait, no, they should know this. All right. So, oops, sorry, hold on. I got to get rid of the chat now. That was in front of that. Okay. So we want to break a little bit. We just did have a question, but remember, and kind of going back to the economic disparity data, that homeownership disparity gap is still fairly significant. So we're looking at 28.5 percentage points between Black African Americans and whites, and an 18.7 point gap between Hispanic and Latinos. And so just as we're doing this webinar, and then as we move on from today, if you will, what can we all do collectively to address racial and economic disparities when it comes to not just homeownership, but this accessing credit, collateral, and capacity? That really gets into that idea of when somebody walks in the door, from the moment they reach out and say, I'm interested in buying a home, or I need help with home repair, what happens next, right? And so how do you decrease those number of fallouts and the number of originations for non-white borrowers? Lamont or Bethany, I don't know if you have anything you want to add.
No, great commentary. I just, bullet item number 2, I just think that banks need to do more to employ people of color in their operations. People tend to relate to people who look like them. And so ensuring diversity is going to help increase the number of loans that actually get done. And some of that is, our African Americans looking to get into the banking industry. Are they being cultivated once they arrive? And I just think that that's going to be an important factor.
That's a huge factor. And also the kind of loan products that are created, the special purpose credit programs that are now being, that have been sanctioned by HUD, and lenders have been assured that they won't be successfully sued for discrimination. It's good to see that there's products finally being specifically addressed to address the racial disparities. And you're right, the number of fallouts, I think it goes back to Lamont's point about, if you're not feeling that connection with the lender, either you're just going to go another direction, or maybe not even get a loan, unfortunately, and maybe not become that homeowner, or just find another lender that you do have a connection with.
Right. It's funny you two bring those points up, because our lender guests will talk about what they are doing in that regard. So yeah.
Good.
Okay, now on to the data. This is where we're going to run through a bunch of numbers related to lending data. And I'm going to go through this more quickly than I even do before, mainly because I would like to make sure we have enough time to talk with our guests. But we have 3 years of comparison where you can see the lending data for the city of Milwaukee by loan purpose. And then also all the loans made to non-white borrowers and LMI borrowers. And one of the things that's fairly interesting and exciting, as Bethany alluded to, is that the loans to non-white borrowers and to LMI borrowers have significantly increased in the last 3 years. I think 2018 to 19 is where we first started seeing this increase. And so it's sort of mirroring the overall growth in loan activity in general. That's just been very active. I think we all know the last number of years have had very low interest rates, which has driven a lot of this. And you'll see there, the interesting thing is home purchase activity in 2021 started closing that gap with refinance activity. And so that's been the interesting, most of the loans made that when we've been looking at this overall in terms of purpose, we're really refinancing loans. And now we're seeing home purchase loans climb up there in terms of the share of loans that were made or originated in the city in that year. And home improvement loans also, they have continued to increase as well over time. And so just note that all the data we look at, there's a little thing at the bottom there that says they are originations, so loans that were made, not applications, and owner occupied only. And then it's not necessarily important now, but we used to have, but 2018 is when refinancing was spread out, separated into 2 categories, which is actually quite informative because the cash out refi gives you a sense of people who are doing those loans to maybe take some equity out. You know, maybe they're doing home repairs or maintenance, big projects and things like that. All right, so the key takeaways is that there was a 10% increase in all loans from 2020 to 21. And the number of loans continues to increase, and it nearly doubled from 2018. So I was doing this chart and I was like, oh, there was 8,400 loans in 2018 and there's like 16,000, you know, 4 years later. So yeah, it was kind of mind blowing, if you will. And then while refinance activity declined, it still is up over 50% of overall loan activity if you bring the 2 together, so refi and cash out refi. However, there was an increase in cash out refi that was fairly significant from 2020 to 2021. So again, people drawing on that equity, home values we know had increased quite a bit. It was a very hot real estate market for a couple of years. Really an owner or seller's market, I think, if you want to say. And so you kind of see the variations in the years by category. It gives you something to think about. Same thing with home improvement lending, which probably could also be mirrored somewhat with cash out refi. There was an increase in both of those. And again, very happy for us to see, very good news that loans to non-white borrowers continues to increase. And that increase from 2020 to 2021 actually exceeded the trend in all loans, the overall increase, which is also very good news. And so again, lots of ground to make up, but the trends are heading in the right direction. So our key takeaways in terms of overall lending trends are mortgage lending had very strong increases in value. I think it will be very interesting to see what 2022 looks like, right, given the interest rate increases that have happened. So next year's report, and we'll try to do it sooner in the year, I think. Every year I say that, and I really want to do that. You know, I think it'll be interesting to compare. And then refinance activity shifted to some more cash out refi, and then our loans to non-white borrowers continues to increase. And so I have another little snip there that kind of shows that it more than doubled from 2018. So the number of loans made to non-white borrowers more than doubled in 4 years. So I don't know if people have any questions. I'm going to keep going into top lenders. So this is always interesting at first, and then I'm like, oh, it's often the same lenders. I don't know. But at the same time, it is interesting to see who moves up and down. And so we usually compare the previous year, the top 10 in all loans, and then we also break it out by category. You'll see that in the next slide. Our credit unions continue to have a very strong presence in the lending market here in home mortgage lending. We also, one thing we noted, Bethany and I remembered yesterday, we were talking Quicken Loans actually is Rocket Mortgage. So at first I was like, is that new? I'm like, no, wait, they're the same. And then we have a couple new, I try to usually star the Tape Group members that are on the top list. And then somebody who is like new to this, I think United Shore and Fairway have always been around there, but they definitely increased their presence. United Shore now is in the top 10. So that's kind of the highlight, if you will.
It's nice to see Johnson Bank getting into the top 10 as well.
Yes. So, all right. So top 10 in 2021 by purpose. So now you see who is it, this is always interesting when you break it out. And I want to also call out and thank Russell, who works at the Fair Housing Council, who did a lot of the data breakdown that I normally do, where we take all the loans we do the top 25 in the city, and each lender we break out. So this is crazy chart that we send out to you afterwards. It's pretty awesome. But he helped do a lot of that work. And it is kind of interesting to see who, particularly home improvement, always has interesting people in the top 25. And you'll see that, and we kind of note those in different ways. But again, credit unions, strong presence, but then it does change a little bit. Wisconsin Mortgage Corp is always pretty strong in home purchase. I believe that's the underwriting arm for Shore West, if I'm remembering correctly. Mm-hmm. And then you sort of see Rocket Mortgage kind of comes up into home purchase. They are usually much more. Quicken was way more strong in the refinance activity over the years. So they're now more in home purchase. And again, a lot of the same players, but there is some differentiation. All right. So the discussion points for this are, like I've said before, the credit unions. We had our first 2 credit unions join Take Root this year, which we were wildly ecstatic about. UW Credit Union and Self Help is coming on board. If we can get a great contact for Landmark, that would be great because they're always in the top. We also, Summit Credit Union, I think would be a great one. They're great, one of our strong bank on partners. So we definitely have a relationship there that we can work with. Sorting by loan purpose, like I think as much as it's a lot of the same, it does give you some context, as I talked about. And then in the top 25, when we send out that list, you'll see a lot more mortgage companies in there. And then you'll see there, I have them all listed there. It's kind of tiny, but in cash out refi and home improvement, that's where you see people in the top 25 who do a lot, or top 10 even, but their overall production doesn't put them in the top 10, for example. But they are very active in like one particular space, like home improvement. And so you see all of those different kinds of lenders or cash out refi where people are getting those kinds of loans.
Yeah, I'm thinking that, just thinking aloud here, that Russell, we need to look more deeply at those 3, Fairway, United Shore, and Loan Depot, at their lending, what kind of lending they do, and then map where their loans are being made. And that's the kind of thing that this HMDA data allows us to do.
Right. Okay, I'm going to actually make a note. I just saw a typo. It's always funny when you see it on your gigantic monitor. So now we look at the top lenders to non-white borrowers by number of loans. This is always interesting too. In the city of Milwaukee, who are top 10 in 2021 and 2020. And again, you see Landmark and Educators and Associate in the top 3 spot. UW Credit Union has moved up. Quicken / Rocket Mortgage also moved up. But again, very glad to see a number of our Take Root members. We like to believe that because of their work with us, that they have their eye on this item in particular. And we'll see that in another chart we have where we break out all of our lenders in that. And we also look at tracks. So not just who they're lending to, but where they're making loans. And then the top lenders in the share of loans. So this is another way to think about it. So you have your volume number, and then, but out of all the loans they make, who is actually making a larger percentage of their loans to non-white borrowers? And you see Johnson Bank then moves up a little bit more on the list, and the list shifts a lot. In fact, we see more of our banks than our credit unions pop up in this, which is interesting, I think.
Right, and if you looked at only purchase loans to non-white borrowers, Associated for the last 4 years, maybe 5 even, has been at the top of not only raw numbers but the share.
Yeah. So share, I think, is informative because it really thinks about if you have are a financial institution and you are operating in a market that is a majority minority market, right? How does your lending reflect that community, right? And so this was, I think it was Maria Prioletta who came up when we were first talking about this information a couple of years ago. She's like, we should really look at the share. And I was like, oh yeah, you're right. Yes. Designed by committee, always messy, but usually you end up with a better result. And then we also look at our loans to LMI borrowers, so low to moderate income. So here's again the list of number of loans. Interesting, you see again, Quicken/mortgage moves up in the list a little bit from the previous year. Credit unions, again, very strong here in the number of loans that they're making. And, but again, lots of great activity on the part of Take Root members as well. And now we'll go to share. And again, the list changes. So this is always interesting to me to see. We see CMG Mortgage, and they're always in this list every year. It's kind of interesting to me. But United Shore moved up into this, so they have a larger share. And so again, this gives us a sense of like, I wonder if we should look at them, and we don't know them. And I will say for Take Root, we purposely don't have a membership category for mortgage companies because they're not regulated necessarily the same way as financial institutions and credit unions. And so while we want to like know where they are and have relationships with them, for them to be members and promote them is like a very different thing for Take Root. So I don't know, Bethany or Lamont, you want to add anything to that?
Well, and the reason for that is that the mortgage companies, by and large, were the major culprits. The more unregulated non-bank mortgage companies were the ones that were giving predatory loans back before the financial crisis started, that caused the financial crisis.
Right. So reaching underserved borrowers, when you think about it, it's useful to think about volume, number of loans, and then the share. So who is actually reaching more borrowers, in terms of all the loans they make, and sort of, what are they doing that might be different, or how, maybe what's their secret sauce, if you will. And then the other thing to really know is that the top 10 lists for all of these have strong overlap with the top 10 lists for all loans. So while there are some changes year to year, who is active in different categories, generally what we're seeing is our lenders that have a strong local presence do better in terms of reaching underserved borrowers. And so the ones that are doing that activity, they're thinking about it, you see that in the production that they have. And then credit unions generally are doing better in terms of volume of loans versus the share. So. Okay, so I'm going to move on. I'm going to just keep going through this data, and just know that if there's anything that you would love us to go do an in-depth session, we could do a smaller type thing, or it could happen through a work group, please put that in the chat, because I know we're doing lots of information. Ooh, Amy has a question that Rocket was considered fintech and isn't required to report HMDA data.
That's not my understanding. Otherwise, it wouldn't show up in the HMDA data otherwise.
Right. This might be related to yesterday when Bethany and I were talking, we said, you thought Rocket was like a division of Quicken, or? When
they first came out, that was my perception. I didn't really know, but then it became clear that it's just.
But if they're rebranding Quicken as Rocket, and Quicken has always reported. So but they are reporting the data. So the last piece that we do is we look at the member market share. So we really look at our Take Root members that are current lender members for this year and last year, and we kind of compare them, the total originated loans and the number and percent that they make in low to moderate income and majority minority tracks. So this gets to not just the who are they lending to, but the where are they making loans. And so, the previous slides, we show them and that more like who are they lending to and what kinds of loans. And so in the highlights, we see that Take Root members originated 24% of loans and LMI tracks in the city. And this is actually an increase from last year. So yay. So that's a slight increase from 2020. And then they still have a strong presence in serving these borrowers. But the other thing you'll see is that other lenders are also increasing their activity in these tracks, which is good for good for our community.
Right, as long as they're,
yes,
appropriate and not predatory.
Exactly. I was just going to say, with the caveat that they are not predatory loans. Oh, okay. Yolanda has a good question. Can a breakout of ITIN loans be done?
That does not, if they collect that information, that's not part of the publicly available HMDA information, unfortunately.
Okay. Good question. ITIN lending is something we have discussed often in Take Root, because those products went away for a while, but I feel like especially with special purpose, maybe, I don't know. It's tricky, but good question.
I'm hoping they come back.
Yes. So member market share. So you see this breakout now of current Take Root member loans or lenders, and then the total number of loans that they made in the city, and then the number of loans that were made in LMI tracks, and then the number of loans that were made in majority minority tracks, and the percentage. And so, I had another sheet where I was saying who had done some actually significant increases year to year. Now I'm like, where did I put that? I will look it up because it was actually quite interesting. I think US Bank, if I'm remembering, was notable for their increases. Oh, shoot. I'll have to put that in some notes afterwards. I'm so sorry. But this next slide actually has the 2020 numbers too. So it's like it's not like you couldn't see it from the presentation. But the interesting thing is that all lenders have actually increased their lending activity in both tracks. So LMI tracks and majority minority tracks. And so usually our Take Root lenders group, it does better as an overall percentage. And so this year, I think they're slightly under, like by 2 to 3 percentage points. And I think that's because you have just that huge increase in overall loans. 2021 was a pretty crazy year in terms of home lending. And we just saw those other increases in the share of making of whether it's LMI borrowers or minority borrowers or that sort of a thing. So I don't know. I feel like one thing I always like to say is that if you're part of Take Root, you're generally doing much better than all the lenders. But again, it'll be interesting to see what happens in 2022 when lending gets a little harder, right? So then what are we going to see to these numbers? And that's the other thing to kind of keep in mind. And here's the 2020 numbers. So we do that on the next slide. The chart is, if I try to put the two of them on one slide, nobody would ever be able to see it. So I wouldn't make everybody try to look at their eyes in that regard. And I'm like really sad. I had this it was my handwritten notes too. So I will try to find those. I think I recycled it thinking I didn't need it anymore, but we'll send it out in the post email, but just sort of some yay, Take Root member lenders for doing better this year or this last year than the year before. So we appreciate you, but you'll see the numbers too are just pretty different from 2020 to 2021. So since we've done this analysis, they usually outperform all lenders, but as I said, that did change a little bit from 2020 to 2021. But that's because the share for all lenders increased. So again, as we said, with that caveat, good to see, as long as these are not predatory loans being made, particularly by the ones we're not completely aware of or who are new. And it's like, what are they doing? And so the other thing to note is that in 2021, Take Root lenders increased their share of loan originations in the city from 16% to 25%, and they continue to have strong performance. And so that means that's also good news because the homeownership rate in the city is significantly less than in the surrounding municipalities. And so we know that's something the city really tracks closely. And I think we've had a lot of media coverage of it in the sort of other part of the market that we're seeing with, investor owners picking up single family homes, which means we're bringing those off market and those opportunities for people. So I know that was a lot of information. Recap. What have we learned over the last 20 minutes or so? Overall mortgage lending was hugely just huge increases, right? And it was just a reflection of that strong home ownership market. Out of our top 10 and 25 lists, we see credit unions, Take Root members having a strong presence, mortgage companies, And who has the largest share to non-white and LMI borrowers? Well, we know a lot of them, and that share is increasing, and that is great. Bethany and she added a little thing to here. We see this through, making sure that people are holding to their Community Reinvestment Act obligations, or not people, but financial institutions. And that there's also been more activity to do community benefits agreements that sort of make sure that they are keeping an eye on these things and that they're investing in these communities. And then geography also is a consideration. I think we see, while there has been some really great increases in that regard, lenders that have a strong local presence and actively engage the community generally do better in reaching underserved areas. So Bethany Lamont, I don't know if you want to add anything before we move on to our next section. I'm going to do a quick time check.
Just to reinforce the impact of CRA and that CRA is spurring many of the banks that are merging or being acquired to focus more on people of color and low and moderate income borrowers, and to really understand that we're watching, and that there are some CRA's teeth are relatively not sharp, put it that way, but it does spur banks to pay attention to that, and we need to collectively work together to help them to meet their obligations under the Community Reinvestment Act.
Chris, yeah, I'd just like to add, I know that you were looking at comparison of which banks had improved their performance, and you want to get that out. But I think that's important. I think we need to figure out what changed in those organizations that allowed them to provide more loans in LMI communities. It seems like there was a huge jump just from 2020 to 2021, and that's needed. And so how can we support that? How can we help them continue to do the good work? And what was the difference? What really changed in their operations?
Yeah, I know. I'm really sad. I think I was like, I'm done with this. I updated and I don't need these notes anymore. Oh, well. And Nicole, thanks for putting this in the chat. In fact, our guests today are going to talk about this idea of bringing more people of color into the industry and what that looks like, which has really been our theme for today. Our next slide is actually going to talk a little bit about just these other market dynamics we want to just note and acknowledge, if you will. This is basically the same list, I want to say, as last year, because I think not much has changed in this other than in a positive direction for one thing. So like the increasing use of VantageScore or other kinds of ways of tracking credit, we are seeing some really great movement there. However, in the opposite direction, the continued tight real estate inventory, and I added this, last year we talked about the influx of cash buyers, but I think the other dynamic that we're realizing recently through some great reporting and work being done at Marquette University is that bulk buyers. And so people who can buy bulk, and investors, if you will, are picking up these properties, which makes, it's easier to sell for somebody, even though they might not make as much. But again, that's taking inventory off the market that could go to a homeowner in our community. But also, Lamont has always talked about this really well. Like, we have a high number of duplexes in our city, and that's a real opportunity for people to own something and build wealth at the same time. I'm somebody who benefited from that when we bought our first home. So, that is a real thing and something we can think about. And that there's a lot of activity in the green and energy efficient loan space and grant programs, which actually allows, you can partner that up with other purchase rehab products and things like that, given our older housing stock. And then we have lenders that are not CR regulated. So like if they're a fintech or they're not reporting into HMDA or they're doing that cash bulk buying, we may not be seeing that activity. So I just want to acknowledge these are the things, this creates the environment that we work in. Lamont, I don't know if you want to add anything?
I just wanted to also add in that the city in their Homes MKE initiative is looking to provide home ownership and increased rental opportunities. So that's another 100 units of homes that are being developed. CDA is looking to bring on another 100 units. And so there's some opportunities to work with LMI borrowers with those initiatives. And I would just encourage the lenders and other folks who may see this webinar that there are some opportunities to do more. And I would just actually ask them to intentionally try to get into that space, because we're going to need that flexibility to be able to get those homes produced. And then we also are going to be working with people who may not look like the typical borrower that you see. And so there's going to be some flexibility to really make this all work for us.
Okay, thank you, Lamont. So now we're going to shift to what we do know works. And so we'll send out this handout, this wonderful handout that Bethany has pulled together in the last couple of years as a long, long list for our partners of ways to think about the work you do. And really it's about what can we do to ensure that all lenders, not just CRA or anybody, are really doing everything we can to get potential borrowers to the table in a safe and affordable way. And so what can we do to increase loans to non-white borrowers and first-time home buyers, first-generation home buyers? And so really, how do we narrow this gap between the percent of loans that are issued to these groups? And so they more closely match the demographics of our MSA or the county. Things like down payment assistance and home buyer educators and trusted community organizations. This is what Lamont was talking about. These are all great ways that you can do this. The other thing we're going to really focus on today is community savvy loan officers and sort of thinking about who's on the team. And so we're going to hear from US Bank and Associated Bank about what they're doing in that space. And then also think about loan products. So that as special purpose credit programs and those products that are coming on, I think are going to be really exciting to see how we can really move the needle, if you will, over time. So now I am going to invite Sodi Nichols and Yolanda Frontini to, and Chester, I'm not sure if he's able to be on too, but if you want to talk a little bit about Access Home, and then Bethany will do a little bit of Q&A about that program and the work that you're doing. So just let me know when you want me to advance the slide, because I have your slide.
Excellent. Thanks, Christy. It's Sodi Nichols here. Sorry, I'm not able to join you on camera. I'm a bit displaced out of my office this morning, but luckily I'm amongst old friends, so you all know what you're dealing with in me. So you can go ahead and go to the next slide, and I will happily and with a good amount of pride go over this work that we've been involved with now since 2019. Actually, I say that every chance I get because I think it's really important. It is a source of pride for me to know that this organization supported our work in looking to understand this disparity between Black and white homeownership before George Floyd was murdered in Minneapolis. So in 2019, we brought everyone, all of our leaders, our most senior leaders from across the country together in Milwaukee. Why? Well, you know, it's my hood, right? And so I wanted to make sure that even though our work is national and even though my particular position has a national scope, I needed to bring folks here because it's what I knew best and it's a story to be told, right? One of the most segregated cities in the country. And so from LA to St. Louis, Minneapolis, everywhere I could pull a leader, I brought them here to our neighborhood, to this city, so that they could see firsthand what this disparity looks like. We did tours of the north side, the south side. We met with community partners, housing agency leaders, and really throughout a full day brought this front and center to our uppermost leaders in mortgage at US Bank. That was in October of 2019. And within 45 days, we had this pitched, this US Bank Access Home. It was called the Dream Initiative at that point. And the ask was, could we please have $300,000 to do a pilot in Milwaukee that would sponsor partners very specifically around work to advance Black home ownership. So really giving opportunities to some of our most significant nonprofit partners to be able to carve out a space to focus on innovative approaches to this work. We identified at that time these 4 key pillars. Christy, can you pull the next slide up so I can go over those quickly? So we understood at that point that we wanted all of the work done with the bank and with our partners to focus on these 4 pillars: enhanced adult financial education, and a bit of a deviation from the traditional home buyer workshops. We really wanted to focus on the opportunity to have real life conversations with individuals, to understand, before we talk about home ownership, what's your most pressing financial challenge and what's your most significant financial goal? How do we help achieve those things before we can even really start to talk about this pathway to home ownership? We wanted to put the concept and ideation around home ownership in front of individuals that may never have considered it as viable to them before, understanding that we were working against historical barriers here. And so we really wanted to make sure that our partners involved in this work alongside us were having these conversations so that, in fact, we could start this pathway much sooner than where it had been previously. We also understood that youth outreach needed to be a part of this. And this came specifically from the conversations we had in Milwaukee. There were folks that stood up and said, we really need to get the idea of home ownership in front of kids. They need to understand at a much earlier age, if we want to push back against a generational renter cycle, it needs an earlier stage introduction to wealth building through home ownership. We need to talk about what this looks like in real life, how home ownership helps to create opportunities beyond that house. We need to start talking about home ownership to this generation in a way where they're informed that this could help you start your business, utilizing equity in a way that we just never have. And our white counterparts do all the time, right? And so we start to talk about this with kids, and I have so many stories about this particular segment and how this work has shown up and how these kids have responded. It's actually incredible. Christy, I wish I had the time to go through all of those with you, but I'll just tell you all this. If you have an opportunity to engage with kids specifically around home ownership, it will be amazing to you the concepts that they cling onto, and what they walk away with from those conversations are things you couldn't have imagined just by way of your singular engagement with them. And we've done this with a series in many markets across the country, and it's just shown up over and over again how receptive this generation is to the concept of home ownership, and in particular, credit score. They start to really lean in on this idea that having an incredible credit score creates and opens every door for you. And so wouldn't it be amazing if, as this plays out, we no longer have to think, how low can we go on credit score? Instead, we have a generation of folks who are already at a young age understanding and preparing themselves to have incredible credit scores as soon as they turn 18. So it's really been eye-opening for me, the concepts that they lean into most. And again, I encourage you all, when you have the opportunity to have these types of conversations with youth, which is a little bit out of the scope of where our typical work takes us, you should do so, because I really think that's where it's at. Strategic community partnerships and outreach. Again, the original pitch, $300,000. Let me invest in some of these partners, my friends that I know can do this work if given the money and the opportunity to lean in on this work in a significant way, to be able to build strategies and do outreach that maybe doesn't create an immediate transaction, but starts to impact mortgage preparedness. Could I please have that? And then mortgage loan officer development, recognizing that in my role at the organization, I talk to regional and divisional managers all the time about the need for diverse hiring. But I always knew that I was only telling them part of the story, and that never sat well with me. And the rest of the story was, at that point, when I started these conversations with this team here at US Bank, less than 6% of licensed loan officers in this country were Black. So if we continue to recruit the way we always have, trying to find high producing loan officers from another bank and entice them to come over to our organization, we were pulling from a very small pool of licensed loan officers. And so instead, could we please have the opportunity to build out a development program for new to industry loan officers. I can tell you that's not an easy ask. So again, another significant source of pride for me that the answer was yes. And so this past September, US Bank, after many, many months of building out each component of the program, the curriculum, bringing in partners, some names that you'll recognize. Judge Derek Mosley helped us prepare for this group. Denise Thomas meets with them regularly, but we welcome 12 new to industry Black mortgage loan officers to the bank. First time ever done. Thanks, Lamont. I'm going to take that. It's really been incredible. And then another, and maybe you'll put your hands together again for this, Lamont, but Milwaukee is the only market that has two. So we spread this across our Access Home markets. And so you'll see that many have one dedicated in this program. But again, because of our deep roots here in Milwaukee, we have two new to industry Black mortgage loan officers that are currently heavily engaged in our training program. And so back to October of 2019, here are the pillars, here's the presentation. And I'm, again, really proud of the fact that the answer was yes. Yes, and, right? Why don't you spend the first several months in 2020 building this out even more fully, so that we are ready to go mid-year next year. Fantastic. I got money, I got opportunity, and I got time. But how could I have prepared myself for what 2020 was actually going to look like? All hell broke loose, right? With COVID and the disproportionate impact that was having in the Black community. And then, of course, the murder of George Floyd. So what ended up happening, and I'll wrap it up here because I know Yolanda has a lot to share here as well. But what ended up happening is this small ideation around let's do this as a pilot in Milwaukee turned into maybe we'll give you $3 million and you can do this in 5 pilot markets. So that's where this work has been. That's where I have been, here, there, and everywhere, all across the country, building out the sponsorship, standing up the program, and making sure that for year one, which launched May of this year, we were focused on showing up in places, in spaces, and in ways that US Bank had never shown up before. And so again, Access Home takes on various shapes and forms in every community through every partnership. But we've dedicated over $1.5 million to 14 partners currently amongst these 5 pilot markets. And we're soon to expand into California with another infusion of dollars, opportunity, and partners. So that's where we're at today.
That's so great, Sodi. Really, really interesting, chronology of how the products and the work took place. You've answered some of my questions already, but I'm just wondering a couple of things. One about on the development program, how are you connecting the people that are taking the program with actually getting employment within the bank, or are they required to work there from the get-go? How does that all work?
Yeah, so these 12 were hired as US Bank employees. They were given a salary to be able to, with ease, make it through a 12-month development program. I need to say that again. This is a year-long development program. So for many, you understand that that's a huge deviation for the amount of time that is typically spent training mortgage loan officers, right? It's usually 2 weeks and you're in and sink or swim, good luck, and here's your sales goal. No sales goal for this team for a full year. 6 months of solely technical development and another 6 months of really time spent with me and the team that I'm part of. The mentors and managers, Yolanda, Chester, are the names that you'd recognize here, Yanette and Leslie, all this supportive group around these MLOs. And so for the last 6 months, you'll see us here, there, and everywhere, spending time introducing these individuals to the realtor community, to our nonprofit community. You'll already see them actively engaged with us in community outreach and engagement, really elevating their profile. So upon the completion of this program, they've had that last 6 months to build out their pipeline of partners and potential clients. So when I tell you we spent time developing this program, we really did. And so I'm thoroughly excited to see where this group of 12 goes. We paid a salary, for their privacy. I won't share here, but know that by design, it was a significant deviation from entry level, starter, base salary. And that was because we wanted to be able to attract folks that were currently in a specific range of earnings that maybe were already exhibiting strong leadership, maybe a sales acumen in some other right? But just no history in mortgage. And could we maintain where your earnings are at for at least 1 year and then put you on a path to now be tasked with managing your earnings potential for the next decade, right? And really creating these opportunities. So again, 12 months, really, really comprehensive program. And yes, the next phase of it, we recognize really needs to be around that elevation and introduction.
Thanks, Sodi. I really wanted you to elaborate on that, and you did a fabulous job. And thank you for putting together such a great program. And glad that it's being developed or has been developed and is working right now, being implemented, and moving to different markets as well. One other quick question for you, because we need to move on to Associated, but I'm wondering about the financial education and regarding the youth pillar. That's really super interesting to me and really makes a lot of sense. And how do you get into the schools? And then how are you connecting on the adult financial education? Is that through your own people or connecting with the home buyer counseling agencies, or both?
Yeah, so both, definitely. So let me start there and work back. So both. Yolanda, who's here. Yolanda, are you on camera?
Hi.
I'm an old face to these folks, but you're newer.
Yeah, I can't tell if I'm on or not. Oh,
there you are.
Yeah. Hello, everyone.
So yeah,
I had to join on my phone, unfortunately. But yeah, this is wonderful because that piece is so important to us and something that we're doing. We're collaborating. Let me give you an example. We recently did a big event at Evolve Church where we had over 500 individuals come, and it was entire families that were invited. So I know that in the Brown and Black community, myself being Hispanic, growing up in a 4-generation household, faith and education were very important. And while I grew up with my grandma, my great-grandfather, who went to school at 2nd, 3rd, and 4th grade level at best, because they had to go out and work in the fields where they came from, they understood the importance of education, but they weren't aware of the resources that were available to them. And one way that they found resources was through the church, faith-based. So that's something that we know and we understand. And we're also working and collaborating with churches and schools to be able to execute and deliver on these pillars. So that's something that we're going to continue to do, and Evolve was just the beginning. And we also work with Safe and Sound and other organizations locally. And we make sure that the people on our teams, especially in this new program with the trainees, I'm excited that the 2 trainees that we have, it was very important that they be active in the community, that they have the emotional intelligence, that they have the cultural knowledge, all of that, so that they can be successful in this program.
Thanks so much.
So yeah, Bethany. So Yolanda's team is heavily involved in financial education outreach. Our youth outreach, you don't have enough time for me to tell you the ways that this work has shown up. I'll give you just one quick example because it's kind of a cool story, and I promise I'll wrap it up. But we have engaged with former NFL player Keith Jackson of our Packers winning team back in the day. Keith Jackson leads a nonprofit organization in Little Rock, Arkansas. He serves over 600 youth every year. And we have hosted throughout this year a US Bank dinner conversation series. And this is just the kids coming together for a very fancy dinner, which we were always guests of, and sharing a conversation at the dinner table, because we recognize that in Black and Hispanic households, that doesn't happen often, right? It's not something we talk about. We have to go into the other room when finances are being discussed. And so let's have these financial focused discussions. And I'll just tell you that I came back from Little Rock a few weeks ago for the culminating dinner conversation of that series. And the host for those at that dinner for their parents were the kids. And that's where I got to really hear what they took away from this year-long series that we had. So I'm glad Yolanda mentioned Evolve Church and the partnership there, because we'll be hosting a dinner conversation series there as well. So that's just but one example. And again, there's enough room for all of us in this space. There's kids for each of us to reach out to in a significant way. So that's how we did it. And we're looking forward to additional opportunities.
Thank you to you both.
Yep. Great.
Very exciting work.
Thanks, Stephanie.
I'm hoping the other bankers are taking notes.
Well, thank you. We're going to shift now, and I'm going to introduce Heather and Eduardo Pereira Meyer into the conversation to hear how Associated Bank has been doing and some of the things that they've been doing around building their mortgage team. And so I'm going to not share my screen because you don't need to see the slide, but we'll have Heather and Eduardo come on. And I will just note, we're going to probably go about 5 minutes over. We only have a couple of slides after that. So if you can stay on, that would be awesome.
Great. Thanks, Christy. Eduardo, it's so great to have you with us this morning. Wondered if you could just start off by talking a little bit about when Associated Bank first decided to start building a team of CRA mortgage loan officers.
I think we decided to basically come up with a MCA area back in 2013 approximately. And so that's when we started the whole process. It took a few years to put it together, but based on the footprint states that we have. So,
okay, great. And what kind of ideas did you have in terms of who you wanted to hire so that your team reflected the diversity of our community and where the bank has that presence, that footprint that you were talking about? Did you look internally? Did you look externally? Were there key qualities that you were looking for in the candidates?
So a couple of things, right? So our loan officers reflect or kind of mirror the communities that we service. They have to provide the knowledge and provide solutions to the problems that the customers have, right? But they also have to have the understanding of our first-time home buyers. They have to have the patience, because a lot of the times we have to explain to them multiple times. We have to get the nonprofits involved to help explain the process and to kind of help us out to hold the hands of the customer as we take them from the beginning of the process to the loan closing. A lot of the times after we're closing, most of those customers end up coming back to us for additional questions in terms of servicing, whether they pay their taxes, or when they have other customers or other relatives that are wanting to do financing, they're always reaching out to ourselves. One of the things that we also have identified, and I think Sodi talked a little bit about this, is that we needed to develop the future loan officers they have that identify with the community. They have similar interests. And so we also came up with a junior loan officer program as well. And the same conclusion is that there was no way that we could throw somebody into that position. And then after a certain amount of months, we expect them for them to be originating and producing. Our program runs in a 2-year program. They shadow a lot of the loan officers that are currently working in the market. They get to know the nonprofits. They get to know the contacts in the real estate industry as well. So some of those are things that we have come up with as well. So
you mentioned working with nonprofits a couple of times. So can you talk about what ways you and your team have introduced yourselves, partnered with, worked with local nonprofits, including housing counseling agencies and other, community-based or neighborhood-based groups?
Yeah, one of the systems or processes that we do very well is that when we are meeting with the customers, whether they're ready or not, our products and services require the home buyer education, whether it's a portfolio loan or if it's a conventional loan. If they're receiving down payment assistance, it's required for them to have the home buyer education piece. So we provide the referrals over to the nonprofits and kind of continue to follow up with the customers and also with the nonprofits as well. The other thing that happens is that we're constantly evaluating our process, right? So what is working, what is not working. We do rely on the nonprofits to provide feedback in terms of our products, our services, are they reaching the market that we need to reach, right? Are we able to recognize what's taking place in the marketplace? And then are we able at the end of the day to get the loans done, right? And so not just from the nonprofit sector, but we also have created community accountability so that we can rely on the feedback that we get from the nonprofits, right? So we have a board that we meet with some of the executives of the nonprofits to get some of the feedback so that we can make changes to our loan products or find out what are we missing, whether it's small business, whether it's commercial, whether it's down payment assistance. So those are all the type of things that we rely on or get some of the feedback from the community and our community partners as well.
That's great. That's really great to hear. Just one final question I wanted to ask was, what advantages do you think having a kind of the team approach brings in terms of helping get prepared for homeownership?
So before I forget, I think one of the things as an organization, we have a commitment from the top to the bottom, right? So everything that we're doing in terms of programs, in terms of all the changes that we're doing, down payment assistance, that require money, right? So we have to have the commitment from the top to the bottom. We have dedicated processors that are working in community lending they have knowledge of the down payment assistance. They know how the loans should be structured. We have the closing area as well that has the ability to do the paperwork that's required for the down payment assistance programs. The continuous evaluation of our compliance area is very helpful because on a quarterly basis, on a monthly basis, we are looking at the data and that data is very valuable so that we can change and we can make changes based on that data as well so that we don't have to wait till the end of the year or on a quarterly basis as well. And then, like I said, community accountability does help us in the sense that,
yes.
Sorry. Oh, okay. And so the community accountability does allow us to, as our loan officers are out there in the community, they might be able to identify other opportunities, whether it's commercial, small business side. We can get the community accountability department involved so that they can match or bring to the table the right individuals from the bank to provide solutions to that area or to the nonprofit. So,
great. Thanks so much, Eduardo. Really appreciate you taking the time. Yeah.
I just want to add that it was an interesting conversation that Heather and I had actually at UWIDA's annual gathering because first of all, both of these banks really showed up. So thank you because your team members came to our annual gathering and helped celebrate with us. But just hearing a couple of them talk about, like I was talking to Ewell with US Bank about his experience in the program so far. And I thought, wow, that's really great. We should really make sure we share that. And then I was talking to Tamara Kessel at Associated, and her and Sandra were just talking about how they work together to help customers. And Heather had a similar conversation. We were like, oh, this is the kind of work that you don't often hear about, that day-to-day that our mortgage loan officer teams are doing. And we thought would just be really helpful to share. So thank you both to US Bank and Associated Bank for, I see Bethy's about to say something, just for joining us today and really giving us some insight on how you approach that. So Bethany?
Absolutely. So I too thank you for sharing these strategies, because they really are important. And I wanted to just pick up briefly on something Eduardo said at the end there about accountability. You know, you mentioned that 2013 was when you started thinking about some of these issues. 2013, and I will say that one of your lead people within the bank has admitted this publicly, that 2013 is when the complaint, the discrimination complaint against Associated took place. And ever since that complaint was settled in 2016, your work has gotten better and better and better every year. And really, you know, it seems like you took it to heart and are being serious about the efforts that you're undertaking. And also regarding accountability, the CRA asks for community input. And so to the rest of you who are non-bank folks, when I ask for input on banks and when we have our CRA meetings, it'd be really helpful for you to participate so that we know what's going on in your community and what's not, who's doing good work, who could do better. So thank you for that.
Yeah, I just want to add to one thing I think about when, especially with the banks and stuff, like how we see a lot of people who used to work in community-based organizations are now working at these banks at the local level, and how important that is. And for the financial institutions to have that perspective and hire those folks, and sort of that mindset coming into the institution, and what a difference that makes. Like, we know people like Eduardo and Yolanda and Chester, Sodi are like huge advocates, you know, in the community accountability team at Associated, that are often like a couple voices in a large group. And so, you know, just to really shout out their commitment to the work that they do in their financial institution to advocate for these things is really important. And so that's why we really like to use these webinars to highlight that. So we are going to close out. I'm going to share my screen one more time because we just have a couple. Okay, I'm going to go from current slide. Did this work? Okay, no. There we go. Okay. All right. So just to go back, we want to close out to kind of go back to that blog post we talked about early on. Some of the strategies that they noted would help increase that access to credit, collateral capacity. That, you know, these are not necessarily new ideas. They are also ones that we are seeing here in our community every day. And so you see here, like the targeted down payment assistance, that has been transformative over the last couple of years in particular, where, you know, our city, the city of Milwaukee has used TIF funds. The CDA has secured down payment assistance through ARPA. Like, we just know that is a game changer for people. Like, if they can get their credit done and they can do that kind of work, but having access to down payment assistance, because we know saving is really hard for people to do, especially as incomes have not necessarily matched, right, inflation for most of the like recent history. Having that down payment assistance access has been game changing. Other models that really facilitate stability in homeownership, like community land trusts, and then kind of really thinking about how credit and down payment work, promoting lending to people of color in partnership, so with our GSEs, and thinking about how we can offer protections, and also refinancing, which is a very different conversation now than it was even a year ago, given the rates and things like that. But that could be a strategy for some families to perhaps build wealth in some way or maintain their home. Like, we can think about how our group can really have people. And I think Sodi alluded to this, but it reminded me of when I first started UWITA, I was doing financial capability programming. And the first realization I had was, oh, we just assume people talk about money in their families. Like, most people don't. Money is weird. People don't like to talk about it. Most people don't grow up in families where they really talk frankly and openly about money. And so you have to remember that if like somebody walks in and it looks like their credit's not all together, they don't have, they could have never talked about that. And so I think that refinancing is a good way. You might get somebody in home ownership, but refinancing is a totally different mindset. So who in our community can help people think that through and be smart about it and not put themselves or their home in financial jeopardy? And the special purpose credit programs, which we have talked a lot about. UWITA actually had a recent emerging topics series in September that really talked about that in depth. And so we can actually include a link to that. I'll do that in the follow-up to that as well. So it's posted on our website. So those are some just strategies that came out of that blog. We wanted to remind you all. We highlighted the ones that are being actively pursued here in our community. And then the next slide, I'm going to have Lamont and Bethany join us to kind of like just think a little bit. We talked about this earlier about what really affects our ability to close these gaps. So I'll hand it off to you too.
Yeah, I think we touched a little bit about that. I think, being African American and having had some challenges buying a home, I think there is a tendency to, when you're overwhelmed, to kind of shrink. And I apologize for putting the race in there. I just think that's human nature, So when you're faced with a challenge, sometimes you shrink or you rise to the challenge. But when those barriers are just overwhelming, I think the most of us are going to shrink. And that's very true about doing something that you've never done. And we kind of have to change our culture a little bit, with the tendency to accept rental situations. I'm amazed at, having worked with so many homeowners in my career. Sometimes it's not that they have this tremendous amount of income or that they have all of the things in place, but they have this desire to do things, to own a home. And so for, many of us, we just got to tighten up sometimes. You have to curb your spending. You have to kind of want it. You have to got this, and that's really hard to say, someone doesn't want it. I don't mean to slight anyone, but sometimes it's just that drive. How can you drive yourself to get to the finish line and say, you know what, I really want to be a homeowner? I've been working with someone who's looking to start a business, and it's in a field that I have no experience with. And it's just so overwhelming because it's new to me, right? And so all you can do is just immerse yourself into it, learn what you can. And that's what we need. We need more programs that are going to teach people about homeownership, teach them about the steps that they need to go through to get to that. And then we need to be there as a community to support them in all ways. And sometimes it's not the direct action, but it's indirect things. It's listening, it's supporting them. And so I think most of us in this field, we do that. And it's just that we're going to have to continue to do that, and we're going to have to do more of it.
Yep. Bethany, I don't know if you want to add anything.
No, I think you guys have covered it. I'll just leave it at that.
I was just going to say, Lamont, your comments just brought to mind something I've been thinking a lot about in the last couple of years, because I've been doing so much work in housing and both home ownership and rental housing. But that bullet point about like transactions and relationships and like navigating coaching, like I think like, at any day, it's really about people. Like we can look at loan numbers, we can think about strategic investments. Those are all important too. But at the end of the day, it's again, who do they talk to when they come in the door? Who is there for them to say, I know today it seems overwhelming, but tomorrow is a different day. And I know somebody who can help you, right? Or I will be the one to help you get to yes. Like, I think that's to me, like, I just keep coming back and back. And then, so it means that you're working at a very micro level with people one-on-one, and any of us can do that for somebody. And
it's an open door process. I mean, it's, someone may be denied today, but hopefully as a loan officer, as a realtor, as a community person, you give them that sense that they can come back to you when you're ready to pick this up again. And I think that sometimes, when we talk about fallout, that's what happens. People don't feel open. They don't feel like this is for them. And so how do we embrace that culture that, hey, you're not ready where you need to be today, but I'm here for you tomorrow, next week, next year. And I think if people can take that, you know, and we do move around sometime in our space. And that's why it's really important for our leaders of these organizations and companies to have that top-down effect of how they're going to change the culture of their organizations, because, you know, we do it on a micro level, but we really got to do better on that macro level.
Yeah, I think that personal relationship is you know, the human, you know, we're human to human, and selling, of course, selling your loan, selling your bank, selling, you know, why they ought to work with you is important, of course, but it needs to be a lot more than selling. They need to have an understanding and be considerate and compassionate and patient. You know, that hasn't often been the case with our lenders, not our lenders, but with lenders in general across the United States. I do think it's changing some, and we need to continue that trend.
Yeah. So our last slide, 2 slides, this is just a sample of the worksheet that we put together to get all of those information that we presented today. So this is our top 25 for the city. We also do one for the county. So it's in the same file. We will share that in the post email, so you can see all the details. We also break out our Take Group member lenders. So even if they're not in the top 25, we have them listed there because we want to highlight the great work that they do. I did find my note sheets, amazingly enough. But I want to say the interesting thing was that a number of our lenders increased the number of loans that they had made. So like BMO was much higher. Some of them I realized too, I'm like, oh, they added people to their teams over the last year, you know, in that time period. But the cool thing is that their share in those LMI and majority minority tracks remained the same or went up. And so that's another thing to think, as loan production goes up, are you keeping that activity, matching it or increasing it? So we'll send this out to you all. And then lastly, thank you. We appreciate you all, and we're very glad you could join us. We have our contact information. We'll send out the links and slides and recording. I'm going to stop sharing so you can see me. But we appreciate you staying on a little bit late. And thank you to our guests from US Bank, Sodi, Yolanda, and Chester, and Eduardo from Associated Bank for joining us today to share some of them. If you have ideas for any other upcoming roundtable webinars, please let us know, or it'll be a great quarterly meeting topic for Take Group. Again, please reach out to Heather or myself or Bethany and Lamont too, and we will add it to the hopper, if you will.
And if you want some loan data, some home loan data for your organization, or even just for your own personal knowledge, let me know.
Yes. So thank you, everyone. Have a good weekend. Happy holidays, as Brenda says. I am just getting settled back into